Steve is 46 years old, lives in Colorado, makes good money. He's been investing for almost 15 years, and on paper, his portfolio looks great. He's got $185,000 spread across 12 different funds, a large cap growth fund, a tech fund, a total market fund, a blue chip fund, an international fund, a bond fund, a couple sector plays he picked up from Reddit, and 3 more he honestly forgot he even owned. Steve thinks he's diversified. He thinks he's covered. But here's what Steve doesn't know. 4 of those funds overlap by more than 60%. They hold the same top 10 stocks. His blended expense ratio is 0.42%. That means every year, nearly $780 of Steve's money disappears into fees before the market even moves. And he's not alone. According to Dalbar's 2025 report, the average stock investor earned just 16.5% in 2024. The S&P 500 earned 25%. That's an 8.5-point gap. And investors have underperformed the market for 15 straight years, not because they're dumb, because their portfolios are too complicated. Here's the thing. Steve doesn't need 12 funds. He needs 3. And by the end of this video, you'll know exactly which 3 ETFs could build a $900,000 retirement portfolio, even if you're starting from scratch today. And the third one, the one the thumbnail didn't show you, that's the one most people have never heard of. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's fix Steve's portfolio. ETF number 1, the engine that does the heavy lifting. Here's the first thing Steve got wrong. He had 4 separate funds all doing the same job: large cap growth, tech, total market, blue chip. They all held Apple, they all held Microsoft, they all held Nvidia. He was paying 4 sets of fees to own the same companies 4 times. That's not diversification, that's duplication, and duplication costs money. So here's ETF number 1, VOO, the Vanguard S&P 500 ETF. 1 fund. It owns about 505 of the biggest companies in America: Apple, Microsoft, Nvidia, Amazon, Alphabet, you name it. If it's a major US company, it's in here. The expense ratio, 0.03%. That's $3 a year on every $10,000 invested. Steve was paying 0.45% across his 4 growth funds. That's 15 times more for the same stocks. And the returns? VOO has delivered 14.9% per year since it launched in 2010. Over the last 10 years, it's returned about 15.3% per year. Over the last 3 years, about 21.5% per year. 1 fund replaced 4. Lower fees, same companies, better results. That's what simplicity does. It stops the bleeding before you even feel it. Now, growth is the engine. It's the part of your portfolio that builds the big number. But an engine without fuel stalls. The second ETF does something VOO can't do. It pays you and raises that payment every single year. ETF number 2, the fund that pays you to wait. For years, people were told the same thing. Put your money in stocks for growth. Put it in bonds for safety. The old 60-40 rule. And for a long time, it worked. Bonds paid 5 to 6%. They cushioned the falls. They gave you income. But that world is gone. Over the last 10 years, the total US bond market, that's funds like BND and AGG, returned about 1.6% per year. Meanwhile, inflation right now is running at 4.2%. That means bonds aren't protecting your money, they're shrinking it. So here's the question. What if you replaced the bond piece with something that pays you more, grows that payment every year, and still gives you quality? That's SCHD, the Schwab US Dividend Equity ETF. SCHD holds about 100 companies, but not just any companies. It screens for 10 or more years of consecutive dividend payments. Then it filters for strong cash flow, low debt, high return on equity, and growing dividends. Only the best of the best make it in. The expense ratio is 0.06%, almost free. The current yield is about 3.3%. And here's the part that matters most. SCHD has grown its dividend at 11.5% per year over the last decade. The payout has roughly tripled since 2015 and has never been cut, not once. Compare that to bonds. BND gave you 1.6% per year. SCHD gave you about 13% per year in total returns. Here's the myth. Bonds are the safe part of your portfolio. Here's the truth. At 1.6% per year for a decade, bonds have been the part that quietly fell behind. Meanwhile, SCHD paid you 3.3% and raised that payment every single year. That's not a small difference. Over 20 years, that gap is the difference between having income that grows and income that fades. Before I reveal the third ETF, the one the thumbnail didn't show you, drop a comment right now. How many funds are in your portfolio? 3, 10, 25? I read every single comment. So now Steve has growth with VOO. He has income with SCHD. Two legs of the stool. But there's one blind spot left, and it's the one that catches smart investors off guard. The mystery third ETF solves it. ETF number 3, the missing piece nobody talks about. Here's a stat that surprises most people. Over 85% of INTL ETFs underperform the US market over the long run, not by a little, by a lot, for over a decade. So most investors do one of two things. They either skip international completely, or they throw money at a broad global fund and hope for the best. Both are mistakes. Skipping international means your entire portfolio depends on one country. The US market is incredible, but putting every dollar in one economy is concentration, not diversification. And the broad global funds, they're stuffed with low-quality companies from underperforming markets. You get the whole world, including the parts that drag your returns down. Here's the fix. You don't skip international, you screen it. The third ETF is IQLT, the iShares MSCI International Quality Factor ETF. IQLT doesn't just buy every international stock it can find, it filters for quality, high return on equity, stable earnings, low debt. The same quality philosophy that makes SCHD work applied to the best companies outside the US. The expense ratio is 0.30%, higher than VOO and SCHD, but you're paying for the quality filter that keeps the junk out. And here's why timing matters. Right now, international stocks trade at 13 to 14 times earnings. US stocks trade at 21 to 22 times earnings. That's a historic valuation gap. It means quality international companies are on sale compared to their US counterparts. Now, if 0.3% feels high, there's a cheaper option. INTF, the iShares International Equity Factor ETF, charges just 0.16%. It uses 5 quality factors instead of 3. And if you want the simplest possible option, VEA from Vanguard costs just 0.05%. But for Steve, IQLT fits the philosophy. Quality everywhere, no junk, no guesswork. So here's how Steve splits it at age 46. 55% in VOO for growth, 30% in SCHD for income, 15% in IQLT for smart global exposure. If you're 40 to 45, go slightly more aggressive. 60% VOO, 25 SCHD, 15 international. If you're 51 to 55, shift a bit more toward income. 50% VOO, 30 SCHD, 20 international. 3 ETFs, 1 system. But does the math actually get Steve to 900K? Let me show you the numbers, and one of them surprised even me. The 900K math, Steve's 20-year roadmap. Steve is 46. He's starting fresh with his 3 ETF portfolio. He invests $1,200 a month. That's about $40 a day. At a blended return of 9% per year, here's what happens. After 5 years, Steve has about $92,000. After 10 years, he's at roughly $243,000. After 15 years, his portfolio climbs to around $490,000. And at age 66, after 20 years, Steve crosses $900,000. Think about what that means. $40 a day. That's one nice dinner, one subscription you forgot to cancel, except this one compounds. Now here's the number that surprised me. If Steve waits until age 51 to start, just 5 years later, he'd need about $2,100 a month to hit the same target, nearly double the monthly cost. Same goal, same ETFs, but 5 fewer years of compounding changes everything. And once Steve hits 900K, at a blended yield of about 2% across his 3 ETFs, his portfolio generates roughly $1,500 a month in dividends without selling a single share. And because SCHD's dividend grows at 11.5% per year, that $1,500 a month becomes about $2,400 within 5 years of retirement. His income rises even after he stops working. That's the power of a system built on growth, income, and quality. Complexity feels smart. Simplicity builds wealth. 3 portfolio killers and your Monday morning plan. The system works, but only if you avoid 3 killers that destroy it for most people. Killer number 1, yield chasing. Some ETFs promise 6, 7, even 10% yields. They look amazing on a screen, but behind those numbers are unstable companies, unsustainable payouts, and prices that collapse when the dividend gets cut. SCHD's quality screen exists specifically to keep those traps out of your portfolio. A growing 3.3% beats a shrinking 8% every time.
Killer number 2, selling during a downturn. This is the most expensive mistake in investing. Dalbar proved it. 15 straight years of investors underperforming the market, not because the market failed them, because they sold at the bottom and bought back too late. The fix? Automate your investments. You can't panic sell what you don't touch. Killer number 3, stuffing your portfolio with bonds too early. If you're 46, you've got 20 years. Locking 40% into bonds earning 1.6% a year caps your growth and delays everything. Build first, protect later. So here's Steve's Monday morning plan. Step 1, open a low-cost brokerage account. Fidelity, Schwab, or Vanguard. All 3 work. Step 2, set up an automatic monthly investment into his 3 ETF split, 55% VOO, 30% SCHD, 15% IQLT. Step 3, rebalance once a year. That's it. No daily checking, no chasing headlines, no tweaking every time the market dips. Steve's portfolio went from 12 funds to 3, from confusion to clarity, from $780 a year in fees to under $30. And in 20 years, if he stays the course, he's looking at $900K and a dividend paycheck that grows every year. You don't need 30 ETFs. You don't need to guess. You need 3 that work and the discipline to let them. If someone you know has a cluttered portfolio and doesn't know where to start, send them this video right now. It could save them years of drag. Tell me in the comments, what's your current ETF count, and are you ready to simplify? If you're building a portfolio that actually works for retirement, subscribe to this channel. I break down exactly what protects and grows your income. Next video, I'm showing you the exact account placement strategy. Which of these 3 ETFs goes in your 401k, which goes in your Roth, and which stays in your taxable account. The answer saves you thousands in taxes. Don't miss it.